Stock Play of the Day Overtime is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Welcome to the Stock Play of the Day, Overtime Edition. On Monday's Stock Play of the Day, we talked about Dollar General. The symbol is DG. Today, we'll discuss, did we score or did we fumble? Happy Halloween, everyone. At least happy Halloween weekend. On Monday's Stock Play of the Day, we looked at Dollar General, and I figured that I better start by just looking at the markets in general in this overtime edition of the Stock Play of the Day. And that we've had a very volatile week, and the VIX index is showing that. Right now, if we look at the S&P 500 index, we're down 1.5%. We had a pretty big down day yesterday. The Dow is down about 1% right now. That has driven the VIX, or the volatility index, up quite a bit. We see that, as I'm highlighting on my screen, right around 38%, up about 2% on the day on the VIX index, which is just fairly high overall. But there's obviously a lot of nervousness in the marketplace that has been generated by most likely the election, but obviously we still have the pandemic that we have to think about that we're living through as we speak. But if I look at the futures contracts, I'm just going to highlight this a little bit. We're going to talk more about this on Monday's Stock Play of the Day, but we see the VIX index at 38% implied volatility. That's implying that each day in and day out, that we're going to have over a 2% move, either to the upside or the downside, in the S&P 500 index. So that's a fairly substantial move overall. It does not happen that often, and that's what the VIX index is basically stating here by being this high. And if I look at November, which is the futures contract in the VIX, it's implying, going out in time, what the marketplace thinks the VIX will be at, which is after the election. We still see it at about a 34% range. That's up 75 cents on the day. Even January and December, we're still above 30. So the marketplace is expecting more volatility after the election, or basically the same volatility. A lot of times you would see a drop off in the VIX index, in that it's a mean reverting index. It usually reverts to the mean, and the mean, like 200-day average in the VIX, if we look at the chart over here, is down around that 20% level. And we've really not seen those ranges even since the pandemic, ever since the pandemic was, quote unquote, announced. And we had the big drop off in the marketplace in March. Okay, so I felt like I had to address that just because we've had such volatile markets lately. On Monday's Stock Play of the Day, we looked at a short put spread in Dollar General. Now, we had talked about Dollar General all the way back in June. Here we see the short put spread inside the Ally Invest option playbook. And we build this as a strategy that if Dollar General were to come down, maybe we'd be willing to buy 100 shares of it. Normally, that would be the strategy you would look at in a less volatile environment. Would be, I'm going to highlight it here in the rookies corner, is selling a cash secured put. In other words, I'm selling a put saying I'm willing to buy that stock, but I don't really feel comfortable with this type of volatility doing a trade like that. And Stock Play of the Day is just all about learning. Nothing's meant to be a recommendation. So we're saying, based on this type of environment, a strategy, if you wanted to buy more of a particular stock, you pick it, would be to mainly look at doing a short put spread as opposed to a cash secured put outright. So in this instance, I'll go back to the actual option strategy here. Give me 1 second. Our short put spread means that if the market continues on up, we can make the net credit received. It's going to be a minimal amount. We don't have unlimited upside in this instance. It's limited and known to the net credit that we receive. But if the market does come down below strike B, that's our most expensive put, that's the risk factor in our trade, then we're going to be willing to buy that underlying stock anywhere below strike B at the expiration date of the option. Below strike A, though, we bought some protection. We used some of the credit from the expensive put to buy a cheaper put, or reinsure ourselves in case the market just basically the sky started falling and the market just tanked all the way down. So you're got enough volatility in the marketplace that selling a put spread is still going to pay you a decent amount because with this much volatility, all the options in general are pumped up. So you're getting a lot for strike B in this case, and you're taking a little bit of that credit to buy some protection on the downside. So let's go and look at what has happened in Dollar General since we talked about it on Monday. On Monday, we taped the stock play of the day live. Markets are rocking and rolling. I drew a ray across this chart here. This is a 5-day chart, 15 minutes long. So at noon on Monday, this is when the show started. It was a very volatile show in that Dollar General was really moving overall while we were talking about this short put spread. And then this is all day Monday. This is all day Tuesday. It was up. On Wednesday, a little bit back to flat on Thursday, and now we're actually down on the trade overall. The stock is down. Now, the concept here is what was your goal? Were you really selling this put spread to try to buy the stock? If so, you're happy that the market went down, right? Because it's going to give you that opportunity to actually buy that underlying. And we actually need it to come down a little bit more in order to for our put to actually be assigned at expiration. We need it below 205. So on the trade overall, the price of the trade, we're receiving less of a net credit than when we initially put it on because the stock has moved down. But that was our goal when we did it. We were hoping that it would move down and give us an opportunity to actually buy the underlying stock. So if I look at the trade, let's go back and see where exactly Dollar General is at right now. The markets are down. Dollar General is down about 0.75%, down 155, trading at 209. It's actually bounced up a little bit since we started the call. Honestly, it was a little bit lower when I was just looking at it before the show started. And the trade that we looked at doing was 14 days out because we're looking to buy it. By the way, Dollar General, we mentioned this on Monday's show, is going to be announcing earnings in early December. So they're not in the heart of the earnings season. The retail stocks are usually at the end of the quarterly earnings season. And so that is the case here. So we sold the November option contracts. At the time, it would have been about 18 days out on Monday. Now it's 14 days remaining. We sold the 205 put and we bought the 200 put. That means that our risk is 5 points here, and that's the width of the spread. But we brought in a net credit of about 75 cents on that trade. So because of that, our total risk would have been $4.25 or $425 plus commission on this trade if you did a 1-by-1 spread. Now, with that said, that's our risk. But if you're intending to buy the stock, you would have to have the cash in your account to be put stock at that 205 strike. That means you would need if you take 100 times 205, that means you need $20,500 to buy 100 shares of that stock. So that would be the concept, because options trade in 100 shares lots in general. That's the normal standard lot. So you have to, if you're going to do this and you were intending on being long Dollar General for the near term overall, that's the type of cash you would have to have in your account, as opposed to just that $475. All right. Now the market has came down, but it's still quite a bit. It's still 4 points above the 205 strike. I think you would just kind of stay the course here if you're trading it. If I'm doing short spreads and I'm really nervous about the marketplace overall, my first spot that I really don't want the stock to go below is the short strike, the 205 strike. I might adjust the trade at that point in time. But if I fall asleep and the market comes down and it goes down to the 200 strike, I really don't want it to go beyond 200. And here's the reason why, is that at the 200 strike, I'm long that option contract. And that becomes an at the money option. That's where all the juice is, quote unquote, in the options marketplace, is on the at the money option contracts. So because that's an at the money option, it's giving me a little bit more protection. As it continues on down, there's really not any more time value that will be in that option contract. So if I have some days to expiration and I'm trading this as a speculative trade, then I'm just going to close out. I really don't want that market to go against me beyond my long strike. I would set an alert, got to 200, I would actually trade out and close the position no matter where the underlying stock was at or where we were at towards that expiration date. I would just look to close that position out overall. But our goal here is that we want to buy the underlying stock, and that's the way we build it on Monday uh, stock play of the day. And so in this instance, just to show you, if you were to close this trade out, you would do the exact opposite of what you did to get into the trade. So in this area, we have Dollar General down a little bit from when we did the show. There was a point in time where it actually would have been up, so you could have closed it because the market did make a decent move to the upside after the show. But every buy to open, you would change that to a sell to close. And every sell to open, you would change that to a buy to close. Right now, the midpoint here is at a 123 net debit to the account. That's where I would want to try to work this underlying at. And this is the way the trade would look. And I'd hit preview order and I would send that down to the trading floor. But I would be selling to close the November 13th expiration 200 strike put, buying to close the November 13th expiration 205 put, and I would do it for a net debit of 123 to the account. But ideally, in this scenario, we should be happy that the market has came down, right? Because we said we'd be willing to buy it if it went lower. So if that was ideally your goal, then yay, the market's doing it for us overall. All right, that's it for this edition of the stock play of the day. Excuse me. That's it for this edition of the stock play of the day overtime. Have a great Halloween, and we'll see you this Monday on the stock play of the day. Don't forget to click subscribe and ring the bell. Thanks for coming, everyone.